Thank you for everybody who's attending today regarding the Secure Act webinar. I'll first introduce myself. My name is Christopher Olson. I am a senior manager in the Wausau location. And I've been a CPA since like 2011, so I've been actually practicing a lot longer than that, so this will be my 13th year as a public accountant. So, and then my co-presenter is Tony Powers, and I'll let him introduce himself.
Good afternoon. Tony Powers, shareholder here at KerberRose and head of our 401k division, and work alongside our wealth management team that works with individual clients. So thank you guys for attending.
Yes, thank you again for everybody attending. So I know everyone's busy. I don't want to keep everyone waiting and suspense on what we're going to talk about. So we're going to kind of go over the Secure Act.
One quick thing, if anybody does have questions as Chris and I are going along, please feel free to use the chat feature. I can interject and ask the question, and Chris will be happy to answer along the way.
And correct, as well as we will be muting everybody, so if you do, use the chat feature. There will be a time at the end of the individual provisions that I'll talk about. We will then unmute everybody, and if you want to and then you can ask the questions then if you don't want to use chat. So the Secure Act. What is it? It's the actual name of it is the Setting Every Community Up for Retirement Enhancement Act of 2019. It actually was signed into law not too long ago on December 20th. And it actually got bipartisan support, so that's kind of a rare thing. So both the House actually passed it, May of 2019, and then eventually it did reach the Senate. Some minor changes between the two, and ultimately it was signed into law on December 20th. It is considered one of the most comprehensive retirement reform packages in the last 10 years, especially from the retirement side. And ultimately, the design is to increase your retirement, help taxpayers increase their retirement savings. It'll help the plan administrators from the employer side. They say simplify existing rules. We'll see how that goes. And ultimately, to preserve retirement income, because a lot of people now are living beyond living beyond their age or living longer, so they're trying to help the taxpayers preserve that income, and we're going to talk to some of those provisions shortly. But there's going to be also provisions that you're not going to be like, well, this doesn't really help me, or it's not really helpful to the taxpayer. So on the individual side, what we'll be talking about is, there's a change to the mandatory distribution age. The acronym is probably, you may know, is the RMD, Required Minimum Distributions. We're going to talk about the stretched IRA elimination, IRA contributions, CDs, or qualified charitable distributions. There's a provision about a birth of a child or an adopted child. The Section 529, or those qualified tuition plans, were, say, expanded. There's a change for non-tuition fellowships, stipends. Kitty tax, and then we're going to talk about some planning ideas. Also, I want to, if just a reminder, could you guys mute your devices? So then we won't disturb everybody else from hearing this. So if you can do that, that would be helpful. Thank you. So we're gonna, the first part of the provisions is the RMD, the mandatory distribution age. Pre-Secure Act or before 2020, before that, so the RMD age, as everyone knows, is 70.5 years of age. So typically, if you hit 70.5 in 2019 or earlier, you had an option to take your first RMD by April 1st of the following year when you hit age 70.5. And let's say for here, in this example, if you hit 70.5 by end of 2019, you had until April 1st of 2020 to take out your first RMD. Now, let's talk about what's the changes now. Post-Secure Act, so that age now is 72. But I do want to remind everybody, it's for those individuals who obtain the age 70.5 after 2019. So if you hit 70.5 by December 31st of 2019, the old rules still apply. You are still required to take an RMD. If you hit 70.5, let's say on January 1st of 2020, your age is now 72 for your RMD. So that one day makes a big difference. So, and we'll talk about, maybe give you a little examples. Just to kind of reiterate what I just said is, so if you're reaching 70.5 years of age after December 31st of 2019, you will be subject to those 72, the changes to your RMD is now 72 years of age. So what I'm showing here on this slide is, so if your birthday, your 70th birthday was before July 1st of 2019, your RMD must be taken by April 1st of 2020. And the same thing, if your 70th birthday was after July 1st of 2019, and before December 31st, your RMD is April 1st of 2022. And the reason is because 70.5 of years of age. So like I said, if you were born June 30th, you're going to hit 70.5 by December 31st. If you were born, let's say July 4th, you're not going to hit 70.5 until the new year. So just kind of give you an example, you know, that's how when you have to look at your birthday now to determine your RMD. And just letting you know that a lot of the banks or financial institutions or wherever your IRAs are set up, if they haven't contacted you about when you're required to take your RMD, definitely should probably get in contact with them so you have an idea, so they know, or they probably do know that your age, and you're not probably going to take an RMD if you hit that 70.5 in 2020. Now there is for employees who continue to work past 72 years of age, and they're not a 5% owner of a company, they actually can delay their RMD of that employer's plan until they actually officially retire. Now and that's like a 401k plan. But if they had like an IRA on the side, that RMD rule would still be subject at the age 72 now. So a little on this slide, I was just going to mention, like, what if, you know, multiple retirement accounts, let's say if you have more than one IRA, if you don't know this, or you probably do, you can actually calculate your RMD for each IRA separately. However, you can then aggregate those accounts and withdraw from one account to at least as long as it equals your total RMDs for those accounts. So if you had 5 accounts, you can take the one out of like account number 1, but as long as it covers those 5, you'll be fine. Now if you had like a 401k plan, you actually have to satisfy and calculate those RMDs separately for each plan. You couldn't do what I just mentioned for a traditional IRA. Now you can withdraw more, so but you have to at least withdraw up to that RMD amount. So if you want to withdraw, if your RMD was $10,000 for the year and you wanted to take 15 out, that's okay. I mean, you'll be taxed on it, but at least you hit the minimum number. Now what happens if you don't take an RMD out? There actually is a pretty harsh penalty out there. currently a 50% penalty on what was not distributed. Plus there's an income tax side. So, but I did put down there, can it be waived? And typically you can eliminate a penalty. Generally, you got to have a good reason. I would say talk to your CPA, your advisor, and see if this can be done. If it was it's your first year and you just missed it, it could be you would have to have a good reason. Maybe you're out of the country, or there was something that unexpected timing that you just forgot about it. I would say talk to your advisor and see if you can get that penalty waived, because 50% it's a pretty harsh penalty out there. Now, what's the tax implications now that you're deferring your age until 72? I guess it's probably similar to when it was 70 and a half years of age. With an RMD, you're creating more taxable income that potentially could push you into a higher tax bracket. So I'll put on another slide, a few slides after this, about there's like this cliff for Medicare premiums. If you earn an extra $1, you're going to be pushed into the next level of paying those higher premiums on your Medicare. So just here in this slide, I would like to know there was a current notice that it was issued by the government. What it is just telling you there's going to be a relief to the financial institutions that will provide RMD statements to the IRA owners, probably just not too long ago. What they're trying to do is just trying to encourage these financial institutions to communicate the changes to the owners, especially the ones that are reached 70 and a half in 2019, because you still have those RMD rules for those older pre-Secure Act. And for those people who are going to hit 70 and a half in 2020 and going forward, so they're just going to give that notification to you. And this is notice just telling there's a relief for that. And I did give you a link to for an RMD calculator if you want to go out there. Typically, these banks or your FI or your financial institution, they will calculate that RMD for you. But if you want to go out there to yourself and see kind of what that number is, there's a link on this slide. Okay, so here I was just going to give you a little demonstration, or at least an idea of an example of an IRA worth $100,000. And then you can see on the right-hand side what the changes before the Secure Act, and then to the right of that is the after the Secure Act, and you can see kind of that lighter shaded color. I can't really give you the color because I'm colorblind, so that's a little harder. But you can see after 10 years, the total RMD before the Secure Act is about $45,000. But after, if you're subject to those new rules, your RMD could be, for those 10 years, $115,000. So there's about a $70,000 difference based on age, based on your RMD age. So it's definitely a time right now to contact your advisor. It's just, and I'm going to stress that throughout this whole presentation. Contact your advisors. You may have lawyers, CPAs, your financial broker, or anybody that manages your account. Especially on the managing, then you got the tax side, so definitely contact your local CPA advisor. Now here is what I mentioned a few slides earlier about the Medicare premiums. As you can see from a single filer, married filer, one extra $1, and you can see in each row, can bump up your premiums quite significantly. So, from an RMD side, if you decide to wait a year after you hit that age and like that April 1st date, you still have a requirement in that same year, December 31st, to take out your second RMD. So that may not be the best idea and then you're bunching up all your income. And this may be applicable to you, and you might bump yourself up to the next level for premiums. Okay, so the next topic I want to mention is the stretch IRA rules, or their elimination. So before the Secure Act, and this is after someone passes and they inherited an IRA. So like a surviving spouse or a named beneficiary. Generally, the rules were you could stretch out that value, that IRA, that 401k, of the beneficiary's life expectancy, and that could be a big difference from, if you, a child, like a 30-year-old who inherited an IRA or 401k plan from the account owner. They could have a life expectancy of 30, 40 years. That's a pretty good stretch for that account. For now, so people with the post-Secure Act, so that stretching rule is no longer there. It's gone. There are exceptions, that we're in tax, so there's always exceptions to everything. And so these exceptions are for eligible designated beneficiaries. And for those are surviving spouses, heirs that are 10 years younger than the account owner, disabled or chronically ill, and minors. And what that means is, now with the Post-Secure Act, if I inherited my parents' IRA, I actually have 10 years to take that money out. But if I was able, under these one exceptions, which I'm not, I wouldn't have that 10-year requirement rule to take the money out. And we'll go over that in a few slides. So I want to give you a little example. I got 3 examples to go with to go over those new rules. So the first one is, let's say Mario dies in 2020 and he leaves his IRA to his beneficiary, his sister, who was born 8 years after. Now remember, in one of the previous slide, I said the heirs was less than 10 years of the account owner, so this is going to be one of those eligible designated beneficiaries. Because she is an eligible beneficiary, she is no more than 10 years younger than the owner. Therefore, the balance of that inherited IRA does not have to be paid out in a 10-year span. Now, if she passes and the account is there's still value in the account, not knowing her beneficiaries, if they're not one of those eligible designated beneficiaries, that remaining balance then has to be paid out within 10 years after death. Now, I do want to mention that 10-year, it's not an RMD for 10 years. You're not required to take 1/10, 1/10. You could delay that first year, second year, and third year. But if you delay for 9 years and you hit year 10, you have to take the money out. So that may not be a good situation because that's a taxable income that may bump you up into a higher bracket. Second example, Peach. You probably noticed the names. I'm using Mario, Nintendo names. Peach dies in 2020 and leaves her IRA to her brother, Yoshi, who is now 10 years old, younger than Peach. Now, Yoshi is not an eligible designated beneficiary because he's more than 10 years older, younger. Now, Yoshi is now doomed to suffer the tax outcome. He must now withdraw the balance in his inherited IRA within 10 years after the Peach's death. Now, the last example, Bowser. Bowser died in 2019. Now, he left his IRA to his beneficiary, his niece, Wendy, who is 30 years younger. Because he died before 2020, that IRA that Wendy inherits, she can take that out over her life expectancy under the old RMD rules. Now, when Wendy passes on and there's still a balance in her account, her designated beneficiaries, if they're not eligible, would have to take that balance out within 10 years following her death. So you can see with these 3 examples, I mean, these are just general examples, but you can see that somebody passing on January 1st of 2020 or does have an impact, or somebody passing December 31st and before, it's a big the big deal from a life expectancy, maybe 30 or 40 years. Now you're limited to 10 years for post-Secure Act rules. So, all right, so IRA contributions. Here, the big change was the age 70 and a half. So typically, what the rules were before the Secure Act, if you hit the age 70 and a half, you were no longer eligible to make a traditional IRA contribution. And because of that, a lot of the taxpayers who hit that age, because of that, you weren't no longer to make that contribution. Now, because of the Secure Act, taxpayers over 70 and a half are now eligible now to contribute to an IRA. Now, there's still the requirement that you must have earned income, like wages or any other compensation, maybe like self-employment income. So really, the big change is now that 70 and a half mark for contributions is no longer there from a contribution side. Here, I just wanted to show a graph, a little chart on just over like a 10-year span, like somebody who is now eligible to contribute. They got earned income, but they're contributing to an IRA of $7,000, which is that $6,000 plus the catch-up. And you can see on the left-hand side, let's say nobody contributes, you can see the value difference by contributing versus not contributing. And it's just the time value money with the growth assuming 5%. So in this next slide, when you get up to like maybe a $500,000 type of account, as you can see the total RMD, and that's the required minimum distribution. And I just want to point out that, in this RMD, is now 72 again, what I discussed earlier. So if this person hits 70 and a half in 2020, their RMD is not till age 72 now.
Chris, we did have one question that came in on that. They're wondering if the IRS has established an index table for the new withdrawal requirements for RMDs.
I heard there's supposed to be some additional tables being released by the IRS. As of today, I have not seen them, but they are, my understanding, on the radar of the IRS to update those tables. So I just keep a lookout. We'll continue to see when those tables come out. So contact your local advisor, and eventually they'll come out, and we'll let everybody know. Good question. Thank you. QCDs, qualified charitable distributions. Now, there really wasn't a change. There's a small change. You could still do a QCD. Now, I mentioned earlier about the RMD being now an age 72 for those eligible, but the age for a QCD to take that money out, which is, that still remains at 70 and a half. So just because the RMD now is 72, QCD eligibility starts still and remains at 70 and a half years of age, as I pointed out here. So the number right now is $100,000 per year per person. So, in that case, if you have a husband and a wife, they both can make up $100,000 QCD contribution. Now, there is one difference between what the change. There's a reason why we have this here. So there was a change. Now, what they did with QCDs is, if you're let's say 72 years of age and you make a traditional IRA contribution, $7,000, and you do a $100,000 QCD, you actually have to reduce that $100,000 by that deductible contribution now. So really, your QCD is only $93,000. That's a big difference. It has to do with the deductible portion. So here, I was going to try and give you like a 4-step process to calculate what is the allowable qualified charitable distribution. Obviously, the first thing is to determine your current year distributions. and what's going to be the intended amount to be as a QCD. Then you actually have to look at the remaining, look at my second step, calculate total remaining distributions to be denied. And you actually have to aggregate this. This is not per year. You actually have to look at all the contributions after 70 and a half, and what was non-deductible or deductible. So in this next slide, this is a lot easier because it's an example. So if I have a taxpayer, his taxpayer A, he made a deductible of $7 in year one and made a $4,000 deductible in year two, and in each of those years he made a $100,000 QCD. Now, at the end of the day, he can only take $96,000 in year two as a QCD. Going through all these steps, so just to be aware that if you're going to do a QCD in 2020, not in 2019, these are for changes in 2020 and forward. Going forward, if you're going to make a QCD and you do make a traditional contribution, you're going to be reducing that QCD by that contribution. Now, if you don't make a traditional IRA contribution, you don't get that deduction. Your QCD would still remain at $100,000. One of the other changes with the birth of a child, really what this is saying is, obviously you can take the money out of a 401k or an IRA, but usually there's a penalty before the age 59 and a half. That number didn't change. What I really want to stress is, so if you have a child, a birth of a child, or you adopted a child, you can actually take $5,000 per person, penalty-free, not tax-free, penalty-free, for distributions made after December 31st. Now, you have to do that distribution within 1 year of the birth date, or the adoption is finalized. If your plan allows it to recontribute that dollar amount, you would have to first ask if your employer has that type of option. Then it wouldn't be taxable, but you have probably so many days to recontribute that dollar amount. So before you probably distribute that out of there, just be aware. Expansion of the 529 plans, or the qualified tuition programs. One of the big changes is now distributions can be made to pay student loans. This is retroactive for 2019. So I know we're in 2020, but you can actually take up to $10,000 per beneficiary or a sibling of a designated beneficiary, and they can take that distribution, pay down their student loan debt. Now, the interest will not be eligible for the student loan interest deduction, but do check your plans if you can do this, because there's also state issues. So like Wisconsin, they may not allow this. I'm pretty sure that they don't allow this. There was a recent tax bulletin that just came out that if you take money out to pay for student loan, pay down your debt, they may consider that to be a taxable event. So before you do that, wherever state you're in, just double check if your 529 within your resident state allows this. Apprenticeship programs as well for Secure Act. Distributions can now also be paid for your books, supplies, and equipment. Let's see, non-tuition fellowship and stipends. So generally, IRA contributions like our Roth or traditional, you need to have compensation. So before the Secure Act, graduate students or postdoctoral students, if they got like a fellowship payment or a stipend, they weren't considered to be compensation for this for contributions. Now those payments to those graduates and doctoral students, they are now considered compensation for this IRA contribution. The idea is that so they can start retirement planning now instead of waiting until they graduate and start working. The kiddie tax changes, I'll just briefly mention, but before the act, under an income of a child is always going to be taxed at the parent's rate. Post Tax Cuts and Jobs Act, they switched that to now to be trust rates. Now, let's go to the Secure Act. They kind of repealed those measures. Now they're going back to pre-Tax Cut and Jobs Act rules. So now those unearned income is now going to be taxed of a child, taxed at a parent's rate. And those are retroactive for 2018 tax year. So analysis will have to be done if your child who did file and they had this issue, would we want to amend? So contact your advisor, look at your returns. We're going to be looking when we prepare 2019 returns to see if that had any impact on 2018, and we'll talk to the taxpayer to see if there's a need. Planning ideas, just at the end, just maybe not wait until April 1st, following year that you hit 72. You don't want to be bumped into that next bracket. There could be some options to roll into a Roth account because rates are pretty low. You want to take advantage of those low rates. You will have control. So the idea is to bunch, not to, take a little bit of that IRA and roll it to a Roth and trying to manage what current bracket you're in. The idea is that obviously the pay the taxes now on the conversion, but chances are with how legislation is going, how Washington is, rates are probably going to go up. Now, the inherited Roth, if you pass in that 10-year rule that I mentioned a few slides earlier, those Roth rules do come into play, but from a taxability side, they're not going to be taxable to the beneficiary. Backdoor Roth contributions for those people who have considerable high income. Just to be aware that, you can make a Roth contribution, but first you have to do the non-deductible contribution. But you do have to watch out for these pro rata rules. So if you already have an IRA, and I have an example here. So if John has $500,000 in an IRA already established and he wants to convert a $7,000 contribution to a Roth, not all of it's going to be tax-free. A good chunk of it's going to be taxable. So talk to your advisor if you have this issue. Some other planning ideas, QCDs, just to tell everybody again, it's still the age 70.5 years of age. The QCDs do not count towards your income. They're excluded from income, but just watch out because of that traditional contribution rule. So if you make a traditional contribution, going forward, you're going to have to reduce your QCD by that amount. Life insurance. So some people, you could actually trying to pass on wealth to the next generation because of that 10-year rule for inherited IRAs. It may be better to take the money out of an IRA, pay the tax, but then you're going to buy a life insurance policy or annuity. And the idea is to preserve that wealth, to grow that wealth, so then it passes on to the next generation. And these are just ideas that that are going on the web or talking to other professionals. That these are the things that people are talking about right now. Regarding the 10-year rule, just to watch out for, everyone has their own goals and their plans. So, beneficiary, are they financially irresponsible? So having a lot of income and such at a young age is probably, if they're not responsible, it may not be a good idea. But you just watch out for that 10-year rule. So, this is kind of the time now when you're alive, you can talk to your advisors, your trusted advisors, and develop a plan that that factors in these beneficiaries that you're not comfortable with having that much of income at a young age. And then most of all, I do want to say, do not wait. Talk to your advisors. That could be your lawyers, your CPAs, your financial advisors. Go over those trust documents, look at those beneficiaries on your retirement plans. The best way to plan is the long-term planning, and it's to do it while you have control of all your assets. It's really hard to do when like a death happens and a lot of it, you can't really do much once that happens. And that is it of the individual provisions. If there's any questions, please let me know. I can look at the chat.
Chris, we had two of them that came in.
Okay.
One was on the inherited IRAs for beneficiaries under the age of 18, wondering if they have to start taking it immediately or if that can be delayed until a later date since they're minors.
Yeah, that's a good point. I did pass on that, but I did mention children. Now, what they call about those age and majority, so if a 10-year-old inherited an IRA, they don't have to take that 10-year-old does not apply. Now, you do have to look at state law. We might have to wait for more guidance from IRS, but let's say 18 is Wisconsin. So if you're a 15-year-old student, schooler, and you inherited an IRA, you don't have this 10-year rule until you hit the age of 18. So once 18, then you have until the age of 28 to take the remaining balance out. Hopefully that answered that question.
Yes, I think that does a good job. The second question related to that is the inherited IRA distribution considered unearned income for a minor child that would be subject to the kiddie tax, or is that going to be taxed in a different manner? I'd
have to see what rules are, but I'd expect that it would not fall under the unearned income. It's not investment. It's not dividends or interest. And I would not expect the kiddie tax to fall under that. So I would have to look at the provisions of the earned income definition and if they include IRAs. But I would have to say, 99% that it's not going to be unearned income.
Sounds good.
I'll check on that.
Okay, so if there's not any more questions, I'll jump into the impacts of the SECURE Act on retirement plans. As Chris mentioned, one of the biggest reforms in about 10 years to impact 401k plans and other retirement vehicles. So today I'm going to cover the provisions that are meant to encourage employers without plans to get them established, look at the impact on plans that are out there today, and then a couple other miscellaneous provisions that Chris didn't already cover. So the first one is pooled plan providers. One more, pooled employer plans. Prior to the SECURE Act, we had what they would call closed MEPs, which were 401k plans formed by a related group, similar to like your petroleum association. And then we also had open MEPs. With the passing of the SECURE Act, your open MEPs are going to become PEPs. And under that, there will be pooled plan providers that serve as fiduciaries to the plan and help the plan sponsor manage that plan accordingly. Because this is relatively new, we do expect quite a bit of new guidance coming from the Department of Labor and IRS on this, particularly how those pooled plan providers, say a CPA firm sponsoring the plan, can work alongside that plan if they're providing other services, because under current rules there would be some prohibited transactions violations there. They also have ruled that a PEP can spin off assets into a separate plan only for that employer. That does help in the case of the bad apple. So if there is a plan in there that's not doing what is required, they can kick them out of the group and make them get their own plan. In addition, it does allow for plans to move out of the PEP once they've grown to a certain asset level or participant level to help the overall plan avoid any audit requirements. And this is all effective for January 1st of 2021. The pooled plan providers, as I mentioned, this is going to remove the one bad apple rule. So in this case, if say someone wasn't making timely payroll contributions, they could be kicked out of the plan and forced to their own plan so that they don't ruin the plan for everybody else. The nice thing about pooled plans is that they are going to eliminate the annual Form 5500, individual plan audits, and possibly be able to aggregate multiple plans into one for better pricing beginning in 2021. This isn't that the Form 5500 goes away. It just waives the requirement for each plan to have one. The PEP itself still will have to file. Benefits to the employer and plan participants. If a plan is going to adopt a PEP, it's going to eliminate that current plan sponsor from being a plan trustee and does away with a lot of their current fiduciary duties. As I already mentioned, does away with their 5500 filing requirement. If they are subject to plan audits, they no longer have to pay that on an individual basis. Depending on the size of the PEP, they may or may not be required to have an audit for the entire plan. Plan sponsors would no longer be responsible for keeping up their plan document and the restatements and then the fees that come along with that. And then, as I mentioned, if you're able to pool a bunch of plans together to form a PEP, there's some pricing scale that might be available to the PEP itself. Another great benefit out there is the increased tax credits for plans, for employers looking to start a plan. So for the first year of a plan and the 2 years immediately following, there's a credit for 50% of plan expenses paid up to the greater of $500 or 250 times the NHCEs, or the non-highly compensated employees. The credit can't exceed $5,000, and it's available only to employers with 500 or with 100 or fewer employees. So this is a great opportunity if you're unsure if you're eligible for the credit to talk to your trusted advisor here at KerberRose, or if you're working with somebody outside, reach out to them. The way this credit works is, let's say you had a $1,000 startup fee for the plan and then $1,500 ongoing with 10 non-highly compensated employees. In year one, you could get a tax credit of $1,250, which is 50% of the $2,500 in the first year, and less than the $2,500 for the 10 non-highly compensated employees. In year two, you can get a 50% tax credit on the $1,500 paying, and the same for year three. So a great incentive for plans that aren't currently sponsoring, or employers that aren't currently sponsoring a plan, to look into setting up a 401k plan. Another great benefit is they're allowing us additional time to adopt a plan. So in the past, if you were sitting down with your accountant and suddenly found out you had a great year and were looking for additional tax deductions, you didn't have the ability to set up a 401k plan retroactively. Now, with the rule change, you can adopt a plan up to the due date of your business tax return. So it's a great way to sit down with your KerberRose trusted advisor, figure out where you are from a profit standpoint, and get a plan in place. One downside, though, is this will only allow for an employer contribution to the plan. The ruling doesn't allow for retroactive payroll deductions into the plan. So again, it would just be employer dollars that would be going in for that year. With that change came a change to the non-elective contributions for safe harbor plans. So right now, or in the past, the IRS required that employees receive a notice stating that the plan was going to make a 3% non-elective contribution. That is now waived, and due to that, employers can now make that retroactive decision up until November 30th of the year following if they're going to make a safe harbor non-elective contribution. If they can't make the decision by November 30th, they always have the ability to do so, but it increases to 4%. Another great benefit is that the QNECs, the qualified non-elective contributions, are still available for contributions. So if your plan, or if a plan you're working with comes back after the third-party administrator has done the plan testing and says that a contribution is needed to correct top-heavy status, numbers can be ran to see if it makes more sense to do the 3% non-elective contribution, or if it would still make sense to do the QNEC, and maybe that's only 1 or 2%, and we're able to save some money for the employer. So another great planning tool for plan sponsors out there. There is a change to the automatic enrollment. Prior to the Secure Act passing, any plan that adopted automatic enrollment was capped at a 10% limit. So employees could only be escalated up to a 10% contribution rate. With the change, the government's telling us they really want to encourage employees to save. So employers with 100 or fewer employees can now set that cap at or anybody can set the cap at 15%, but employers with 100 or less employees can also get a $500 tax credit for implementing automatic enrollment in their plans. So if you do have an existing plan that doesn't offer automatic enrollment, now is a great time to take a look at that to take advantage of the $500 tax credit. And for plans that or employers that currently don't have a plan, the previous tax credit we discussed earlier would apply. Plus, if you adopt automatic enrollment, you can pick up the extra $500 tax credit for those first 3 years. A big change in the government wanting to get more people covered as they removed the limit on the 1,000 hours for eligible employees. So going forward, part-time employees that work 500 hours or more can be covered by a plan or will be required to be covered by the plan. They have to work at least 500 hours for 3 consecutive years before they're allowed to participate. There are some caveats on what would be required from the plan sponsor in terms of employer contributions, as well as if you aren't doing a safe harbor plan, how those part-time employees would actually impact your top-heavy status and how they would be counted as non-highly compensated employees. Lifetime income options for 401k plans. Over the history of the U.S., we've seen a big decrease in the amount of pension plans that were out there. So the government is making a push on how to convert 401k plans into monthly incomes for plan participants. But if a plan adopts a lifetime income provision in their 401k plan, there are some fiduciary protections because these are going to be quite complicated. The great thing about them is that they are going to be portable. So if your plan adopted a lifetime income investment option, you elected into that but then left your employer for some reason, you are going to be able to transfer that lifetime income option to your new 401k plan at your new employer. In the past, that wasn't an option, so it was very hard to make these things work. And then going forward, on every 401k statement, at least annually, there needs to be a projection of what their current balance would be as a monthly income equivalent, so that people understand at the end of the day what they can expect their 401k or retirement account to generate for them in retirement income in the future. For those on the call that are administering plans, effective December 31st of 19, as already mentioned, the safe harbor notice for non-elective contributions is now waived. If you are doing a safe harbor matching contribution, that notice is still required. Another great thing is plans are able to make a mid-year change to become a non-elective safe harbor plan at any time before the 30th day of the close of the year, or essentially November 30th, or on or after the 30th day, and that has to go then to a 4% non-elective contribution instead of the 3%, but does give you the ability to do a little bit more planning, especially as your TPA is running numbers and seeing if your plan is going to be top-heavy or not. A couple other miscellaneous provisions to cover. Effective after 12/31 of 19, in-service distributions beginning at age 59 and a half will be available from defined benefit plans, money purchase plans, and governmental 457 plans. This is a big change for a lot of the governmental plans out there that I know we here at KerberRose work with. In the past, you couldn't take a distribution from a 457 until you separated from service. This does give them another option on how to get money taken out. Terminating custodial 403B plans. So there's a lot of those plans out there still that had individual 403B contracts that were extremely painful for plan sponsors to terminate. With the rule change, the plan sponsor can now force the money out of the custodial 403B without employee consent. So it'll be a great way to get those closed up and hopefully fix a lot of the compliance issues that come with custodial 403B plans. And then there is an increased penalty for filing the 5500s late. It's about 100 times more than what the current penalty is. So the obvious answer is to make sure you're filing 5500s on time, but be aware that if for some reason you are late, it's going to cost substantially more money. That's the end of the employer impact. If there's any questions on that, please let us know. I do see one came through as a follow-up question for Chris on the unearned income. Unearned income, or maybe this is an answer. Unearned income includes interest. Okay, there you go.
Yeah.
I'll let you cover it.
Interest, pensions, and annuities. So yes, an inherited IRA to a child is unearned income.
Okay, any other questions? Yep.
The quick question, so the child doesn't have to take the distribution till they're 18. So under the new rules, does it go till they're out of college, or when are they still considered a minor child? Or a child
there's some information that I think a little more guidance will be needed is the age of majority for a child. That could be all the way up to age of 26. And that's probably based on, so we're going to kind of wait and see this on how that works. So if a child is still in college, 24, 25, they may still be the age of majority where that 10-year rule would not be a factor. But once they surpass that age of majority age, let's say it's 27, then they have 10 years from that date to take the money out.
So it may push back past the age of 18 if they're in college, you're saying?
It's possible. Nothing is for certain, but we're waiting to hear from the IRS some guidance on that age of majority for child. So it's possible, but I can't say 100% sure.
Thank you.
You're welcome.
If any questions do come up, Chris and my contact information is there. Otherwise, please reach out to any of your trusted 401k or KerberRose advisors, and they'll be happy to help or get you pointed in the right direction. And again, thank you all for attending.
Yep, thank you.